If you saw inflation break out, are you concerned that you would see Wall Street overreact perhaps to the Fed moving more quickly?
Wall Street overreacts to everything. They overreact on the upside, they overreact on the downside. We can't make policy based on market blips up and down. We have to focus on the long-term economic outlook and on the mandates that Congress has given us. Congress has said our dual mandate is stable prices and maximum employment, and we try to achieve those on average over the long term. Wall Street's going to do what Wall Street's going to do.
But if they do that, it could have an effect on the economy. And for years, people on Wall Street have said the Fed will step in because they don't want a collapse in business or consumer confidence if the markets go down too much. Is that so-called Fed put, do you think, still in place?
Well, I think that we do care about financial stability, and we do know that there's a feedback mechanism, just like there's a feedback mechanism through the currency markets on the U.S. economy. But we at the Fed aren't targeting currencies. We aren't saying we're going to try to move the dollar up or we're going to move the dollar down. We know that there's a feedback loop. So we do pay attention to either currencies or the stock market, but we're not sitting here trying to engineer a certain level of the stock market. And obviously, we want to avoid crises. So to me, I try to differentiate a stock market correction like the tech bubble bursting, which did not lead to a financial crisis, from the 2008 housing bust, which did lead to a financial crisis. We have to work very hard to try to prevent crises, but within that, we should allow markets to move up and down.
Is there any building crises that you see in the markets these days, either in equity valuations, a rapid rise in bond yields, or the dollar's rapid fall?
I'm not seeing signs personally of an imminent crisis building. Could there be corrections? Could there be moves in the currency market or in the stock market or in the VIX, as we've seen? I certainly think that there could be, and we want to keep our eyes open. But most importantly, we aren't seeing massive leverage building up underneath these asset classes the way they did in housing in 2008. One of the key differences from the housing market and the stock market, people are levered in their homes 5-to-1, 10-to-1, maybe 20-to-1. Maybe they had nothing down in 2006 or 2007. So if there's a minor price correction, all of a sudden they're in a negative equity position. Generally speaking, investors are much less levered in their stock portfolios, and corporate America is less levered than housing. And so the debt underlying the asset class is actually very important to how painful a correction is.
There's one class that's building up leverage at a rapid pace, and that's the U.S. government. Are you concerned about the level of debt that we're going to be facing? We saw in the auction market yesterday some concern. There's another auction today, a lot of supply. People beginning to wonder if there is an unlimited appetite for Treasuries, and if not, we're going to have to pay a lot more.
Well, there's no question that the interest rates and the price of those bonds is going to reflect supply and demand. I'm not concerned in the near term, but I think over the long term, the United States absolutely has to get our fiscal house in order. We cannot run ever larger deficits forever. And the biggest question is, it's not just the U.S., it's when will investors look at other markets, other deep bond markets, as a better alternative. So if the European economy strengthens, if their fiscal house is stronger, then investors may say, you know what, we find Europe more attractive. That's going to put pressure on the U.S. So in the near term, I think the U.S. will be fine. But over the long term, we absolutely need to live within our means.
Do you believe in the crowding out theory?
I think of course. I think that if there's more supply coming in from all over the world, I think it's going to have effect on prices and ultimately on rates.
Well, what's driving rates higher right now? Is it the outlook for inflation? Is it a term premium, a loss of confidence in the U.S. government? What do you think it is?
I don't think it's a loss of confidence. I do think it's expectations of larger supply, so increasing deficits. Plus, the Federal Reserve is now on a gradual path to shrink our balance sheet as it rolls off over time. And I think that people are more optimistic. I've been surprised that the tax cut that the Congress passed and the president signed has led to a lot of optimism on Main Street about the outlook for the U.S. economy. If that in turn leads to more investment and then more production and a stronger overall economy, I think that will be good for the U.S. economy, and I think markets are trying to ferret that out. It is not clear to me yet, is this simply a short-term stimulus, or is this going to lead to longer-term more investment? I think time will tell.